Many of you have asked me to do another update on BTI, British American Tobacco stock. It's still sitting between the $29 to $32, $33 range. It's been this way since mid-2023, and it's been trending lower over the long term, trading at the same price it was trading at in 2009, excluding dividends, of course. So in this video, I'm going to do another review on BTI, try to determine if this is some kind of a value trap or if it's an amazing opportunity, and I'm going to share with you a strategy that I used to do with BTI to generate a 15% annual return on British American tobacco. Okay, now if you look at the stock, you look at the dividend, sitting at a 10% dividend. Most companies that yield 10% are normally declining in revenues, so they're not growing, just pure decline. Or maybe it's just the whole thing is a trap, it's not going to last for long, and the dividend is going to be cut. And I'm going to try to tell you why I believe BTI's dividend is safer than you believe, even though it's trading at a 10% dividend yield. Now, for 2023, it wasn't too bad at all. They did decline in revenues. I mean, their tobacco, old school tobacco stuff are declining in revenues, but they have pricing power. So it was mainly price increases that led them to increase 3.1% organic. In terms of the combustibles, they did decline 5.5% in volume, but they were able to raise prices 6.1%, offsetting the volume decline. And they've been doing it for so long. I'm not sure for how long they will be able to do it. As many of you know, BTI is in a new category revenue kind of stuff, well, mainly in vapes and nicotine pouches and many different other things that they are in. They have number 1 and number 2 market share within brands like Vuse, Velo, and many other ones. And it grew over 21% in revenues for 2023. Pretty amazing stuff. Earnings per share increased 4%. So as you could tell so far, the dividend is 10% for a company that's still growing. I mean, it's not growing rapidly, but it's still growing 4%. It's not declining in revenues or earnings per share. And this is something very important to pay attention to. In terms of the new category stuff, they turned profitable in 2023. Over 16.5% of the revenue is now from the smokeless products, and their goal, I believe, is 50% by 2035. And I'm not sure if they will be able to achieve this goal, but I mean, they could. It's very, very possible. Now, in terms of the dividend itself, if it's actually sustainable or not, over a 10% dividend, the company pays around $5.1 billion of yearly dividend, and they did increase the dividend by 2.2%, which is nothing for 2024. But for 2023, it was $5.1 billion every single year allocated to the dividends. Now, the free cash flow in 2023 was $10 billion. This was only a 50% free cash flow payout ratio, which is very, very low. But for some reason, free cash flow is expected to decline to $8.1 billion for 2024. And I've honestly been looking for the reason why that is. I know menthol cigarettes will likely be banned, but I don't think this is going to cause a $2 billion decrease. There could be other reasons, but I've been trying to look on why the analysts revised their numbers so low from 10 billion to 8.1, 20% decrease. And I can't really find the reason. But even if we use the $8.1 billion of free cash flow estimate for 2024, and they have the 5.1 billion dividends for 2024 or 2023, this would leave them with $3 billion of extra free cash flow to do buybacks, to do dividends, more dividends, or to even pay down the debt. And the debt is more payable and more sustainable than you believe. In terms of maturities, within 1 year, over $4.3 billion is due. Between 1 to 2 years, $3.3 billion. 2 to 3 years, $2.5 billion. So nothing more than $2 or $3 billion every single year. And beyond 5 years, you have the $23 billion due. So in the short term, not more than $3 to $4 billion is due every single year. And the company is going to have around $3 billion, even using the lower free cash flow, $3 billion of extra free cash flow to do buybacks or even pay down the debt. And they have access to a lot of capital. They do have some cash, but they also have a stake in a company in India. It's called ITC, which is more of a tobacco smoking kind of company, very big company, 67 billion market cap. They recently started selling their shares. They sold 1.5 billion of ITC shares, and they're going to use 700 million of that to do buybacks because they haven't been doing buybacks, which is good. So now they're going to be buying back stock in 2024, which should increase earnings per share more than the 3-4% they got in 2023, and they're going to use the rest of around 700 or 800 million to pay down the debt. And the best part about it is they still own around 25.5% of this company. 25.5% of this company in India that's worth $64 billion. This is like another $10 billion of extra cash they can eventually access to. But they do have a lock period. For example, now they have a 180 days lock period, so they cannot sell any more shares before 180 days. Whenever they sold, the stock went down, then it recovered a little bit. They sold a huge block at once, one of the largest blocks that's been sold in this company. So they do have a lot of cash, and they have a $3 billion extra in free cash flow, even after using the analyst figures of $8.1 billion. So for me, the dividend is safe. The debt is a lot of debt, but it's actually payable. In terms of guidance, as I said, it's not much of a growth company, but in terms of organic revenue growth, it's between 3 to 5%. So I would not be expecting over the long term more than 3 to 5% revenue growth. Maybe it's a little bit around the 3% range. So it's not much of a revenue growth story. It's more of a shareholders yield story, kind of like Warren Buffett. He bought a lot of stocks before, HPQ, Paramount, and many others. They're not growing rapidly, but they do a lot of buybacks, do dividends, and you could hold them for the long term and get paid, for example, to owning the company like a shareholders yield in terms of buybacks and dividends. So for me, the free cash flow yield is around 15.7% forward, which is 8.1 billion, 15%. And I would not expect any returns more than 15% if you're likely going to hold British American Tobacco. But I do have a strategy that I use on BTI. I stopped using it. It's been like 6 or 7 months. I haven't done it, but I used to do it, and I'm going to share it with you and explain to you how you could make 15% per year on something like British American Tobacco. And the way you do it is, first you buy the stock, of course, you collect the dividend. The dividend is 10%. We did talk about that the dividend is safe. So the 10% dividend is near its peak, and it's not likely to be cut unless you have a major policy change, a major ban that no one has expected. But a 10% dividend, looking at what we talked about in the video, it's safe. So you get the 10% dividend every single year. And you could sell covered calls on BTI, because BTI does not move a lot. It does move a little bit, I have to admit, but it's mainly between the 29 to 31, 32 range, and this is where it's been. So whenever I see such stocks, I love to sell covered calls on them. I don't sell covered calls on stock like HIMS or Palantir because I'm buying them for price appreciation. But you're not buying BTI for price appreciation. You're most likely buying it for the dividend. So if you're buying it for the dividend, you might as well collect an extra yield for holding the stock. So if you do sell the January 2025 calls, which is a 30 call pretty much, you sell them January 2025 covered calls, you get $1.67 per 100 shares. So $167 for the 100 shares. Now 167 of 3,000, which if you buy 100 shares at $30, it would be pretty close to 5.5% yield every single year. So you get a 5.5% on top of the 10% free cash flow yield. This is pretty close to 15%. Now we're in April, and yes, this expires in January, but I mean, it's pretty close to 15%. You could say 13, 14, or 15% return. Now, if British American Tobacco goes down, so it goes from 29 to 27 or 26, then you could buy back the call much earlier for a much lower price because it decreases in value. You could buy it, so when you collected something like 167, you could buy it back for 98 cents or 95 cents, and you could make maybe 2 or 3% in a short period of time, and then British American Tobacco goes up and you do it again. It's not too complicated, but it's just mainly collecting an extra dividend yield while you wait, or a yield in general in terms of selling covered calls. And this is just my opinion on BTI. British American Tobacco, I think it's undervalued. And if I had to buy BTI, this is what I would be doing. I would not be betting on price appreciation. I would be collecting the dividend and trying to get an extra yield, maybe with covered calls. It wasn't financial advice, just my opinion and what I used to do. So I hope you enjoyed the video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.